Hello and welcome to FTSE Funds and Finance, the straight talking podcast brought to you by Goodwin Financial Services. I'm joined again by Steve Goodwin and Josh Goodwin of Goodwin Financial Services. Gents, we haven't done a podcast for a couple of weeks. You've been on holiday.
Been a nice break, but it's all been good.
What a couple of weeks. So the last time we did the podcast, we talked about trust. That's now long gone. Big changes, new Prime Minister, Rishi Sunak. We thought Truss's policies were crazy. We were proven to be right. So obviously change of Sunak now. What do we expect this to affect the markets and the average Joe?
Okay, so let me say that I was very critical of Truss. I said that this was lunacy, and it proved to be the case. What we've got with Sunak is stability to the markets. Now, it doesn't matter if everybody that's watching here is left, right, middle, centre, extreme right, extreme left. It really doesn't matter. But the country needs Sunak at this moment in time. Now, what he's going to bring, a lot of people are going to say they don't need him, but in terms of what we do, we need him. Because what he's going to bring is stability and confidence back to the markets. Unfortunately, what he's going to bring to people is reduced incomes. Mm-hmm. He's going to bring, on a temporary period, he's going to bring lower incomes and lower standard of living. Mm-hmm. Now, I'm not saying that I'm totally in agreement with the policies he is going to bring out, but it's far better and it's more acceptable from the markets than what Truss was going to do in spending money that we didn't have. So I'm expecting, you've already seen in the opinion polls a narrowing now to about 14% from 30%, which I did expect. That could well widen in the early part of 2023 as he dishes out the medicine, which is going to come. Mm-hmm. But always remember that Sunak, in my opinion, is a very, very intelligent man. Mm-hmm. And he's also a very intelligent politician. He has an election to try to win, which... and this is quite interesting. When he got into power, Keir Starmer was 5-1 on to win the next election. He's now only 4-7 on with the bookmakers to win the next election. So even the bookmakers are now saying, hold on a minute, it's not as sure as it was. Because what Sunak will do, I'm expecting him to do things like freeze the threshold for where you can free tax money. I'm expecting him to do little things that will come on board. I hope he does things like puts a windfall tax out there, because I think it should be the richer that pay, and these companies that are making money pay. But he's going to have to raise money, and at the same time, it's going to be quite painful in the short term. But the idea of making it more painful in the short term is that by the time we get to the end of 2023, he can release it and make us all feel that he's been the messiah that's turned it around, and in 2024 it will be better. So I'm not going to slate off what he's going to do. He's going to do what he's going to do. But I have confidence that the man is smart enough to make good decisions. And at least if he's only here for 2 years, until Starmer gets in power, he's going to stabilise the country for 2 years. And stabilise the markets, and stabilise, hopefully, the investment. Because he's got difficulties with the UK investments, because if we don't do something a bit smart, we'll be going to the IMF for a bailout. Mm-hmm. So but I've got confidence he's going to do that, and I think that on the curtails of what America does and the markets do in America, then we'll come on to this. I expect to see, I hope that investments, and I expect to see investments grow over the next 14 months.
All right, we'll come on to it in a minute, and we'll briefly talk about how we think what Rishi Sunak might do. Josh, you're for a younger generation. What difference does Rishi Sunak come in to you? Is it something you would notice about clients your age? Is it something they're talking about, something concerned about, or is it just very much the same?
I think it was very much the same. I think obviously some people in my generation still aren't that interested in politics, but I think the ones that are, you can't really have a different opinion. That was utter chaos previous to Rishi coming into power, but. Yeah, I say it's fairly similar. I think Rishi's what the country needs right now. But yeah, that's pretty much it.
So you're of the same opinion as Steve? You think that he's going to stabilise the markets over the cost of Rishi Sunak coming in and the policies he's going to bring?
Yeah, you can see that already. Obviously, you haven't actually enacted any policies. I think it's coming November 17th.
Yeah, they pushed the budget back, didn't they? Pushed the mini budget back to
you can't rush those type of things. Obviously, you need to get the right forecast done. Also, they're talking about tax rises coming. I just hope that they spread the tax rises between the middle class and the real high earners. That'd be my one worry as a.
So let's touch on that a little bit. How do we think he's going to raise this money? What do you think he's going to do? What policies? Again, we don't know. We're guessing. This is just us surmising from this point. But
I would guess that he's going to reintroduce his national insurance hike.
Mm-hmm.
I've heard that he's going to freeze, as my dad said, the threshold to the 12,500.
Mm-hmm.
And I would imagine there might be some form of 40-45% maybe going up slightly. I'm not sure. They're the sort, or go for dividends or capital gains. They're the areas I imagine he
explain
will
explain what you think about dividends and capital gains. What do you think he can do?
Increase them. Dividends and capital gains are lower than the income tax thresholds. Mm-hmm. My opinion is, if you're in a position to receive dividends, you've either taken a risk in the markets or you've created a business. So you should have some better reward.
Yeah.
However, they are far lower than the income tax.
Sure.
So that is one way Rishi could start bringing in extra tax.
Bring it up lower, but not as high as the income tax.
And then he hits people. He doesn't hit the average person. I don't know what the statistics are, but I'd imagine not many people in the country actually receive dividends.
Mm-hmm. And Steve, do you expect the same thing? What do you expect him to do? I know you mentioned about the windfall tax. I know you said he's
what
going
I expect him to do and what I think he should do are two different things.
Mm-hmm.
I think that he should move capital gains tax in line with income tax. I think he should do that with a blink. Now, people that own, I'm not talking this from a selfish point of view because I own second homes, but people that own second homes and rent them out, they should pay income tax on them. They shouldn't pay capital gains tax on them. They've got a capital gains tax exemption on second homes, and then they only pay 18 or 28% depending on the tax rate. Well, that clearly to me should be 20 and 40. And that's fair. I mean, I believe in fairness, and I believe that he should do things like that. And there are certain taxes that he can rise that would be fairer and would be paid for those that have multiple things. Now, I'm much more in favour of people taxing second properties than I am of people taxing dividends on business, because, as you say, when you set up a business, if you create more wealth in your business, you can employ more people.
Sure.
But once you've decided to spend that money and decided to buy more wealth for yourself, then I don't see why you should be given tax advantages. So I hope that he does, and I could go into a lot more detail, but I hope that he does things like that, as Josh says, rather than hammer the average earner and basically make the lower earners poorer. That is not, in my opinion, the right thing to do. But
the danger is a lot of business owners are Conservative voters.
Sure.
So you risk alienating
the voter. Okay, well, we don't want to get too much into it, but it's interesting to see, so we'll find out in the next couple of weeks what happens. We briefly mentioned about the world markets, what's happening there. I know you wanted to talk a little bit about the American market and what's happening, the impact here. So, for since Sunak's come in and what's been happening with, the world market.
Okay, so what we need to, if we go back 6 months until... To what I thought would happen in 6 months. I haven't changed my position on what happened 6 months ago. Now, the falls during the first part of the year were deeper than people thought. We thought everything would be volatile. We thought the markets were vulnerable, and could fall. But what has happened is, due to different circumstances around the world, and the problem that they've had with inflation and Putin, it was deeper than people would have envisaged prior to that. But what I did think would happen was that I said that I thought the back end 3 months of the year would be quite positive, and it would lead into a good year next year. Well, so far, October was a winning month for markets. So that has happened, and November started off well as well. So as we sit here today, what is happening out there? Well, America is ahead of the curve with controlling inflation. I'm expecting both the UK and America to go up 0.75% this year by the time this is published. We'll see if we're right. But I think that in America, the signs are that the interest policy is working. And I think that they will be able to adopt a less money tightening program in December, January. Now, because that is now the markets are looking at that and seeing that may happen, there's been a bit of a surge in American markets. Now, this is also being helped in China, because as I've covered before, China is fundamentally in the best economic position. It has low inflation, low interest rates and high GDP, but the country's COVID mad in that they are locking everybody down. And so we've seen that the Chinese market over the last few months has been affected by the COVID restrictions. But in the last couple of days, what we have seen is that the Chinese government it seems that they are going to start releasing these COVID restrictions. And in the last 2 days, the Hang Seng's up, I think, nearly 7%. So that has also inspired world markets as well, because if China starts to produce rather than locking everybody down, that's going to help the rest of the market. So we have seen American markets rising, China on the back of China rising, and in the UK with Sunak adopting some stability, we've been feeding off the back of that. So this is what you would expect to happen. Now people will say, well, things look terrible. But what I've said, markets look 3 to 36 months ahead. They don't look at what's happening now. What's happening now, what's happening yesterday, it's all been pre-priced. So they're now looking to say, hold on a minute. By the end of 23, we can see that we think this is going to be under control. We think Sunak has dished a punishment out to help the UK market, and we think that the US market will be driven to making sure Trump stays out of power by driving the economy forward next year. China is releasing COVID, so to me, the signs are that the market's going, we may have some respite from all the bad news, as long as Putin doesn't drop a dirty bomb, and they're now looking forward and more positively, which is great for us investors.
So we're expecting to going into the end of this year, into the market, you expect it to the markets to rise?
Yeah, I mean, on a balance of probability, again, we don't know. You didn't know Looney Liz was going to come in and do what she did. You didn't know, you had the Putin invasion. But things can change. But I have no reason to change my opinion that I thought that the 15 months from October this year until December next year would be positive. And I still believe that to this day. And, I say to clients that are investing at the moment that I think that this is a particularly good time to invest, whereas you'll see a lot of clients at the moment thinking, things have been bad for the last 9 months. It's not the right time to invest. And I know we're going to touch on that. But the signs are now a lot more positive going forward.
Yeah, so that feeds in ultimately the topic of what we're going to talk about. I know we cover the latest government news and the world markets, but our theme for today is when is the best time to invest, which is the question that everybody's looking for, and it's the golden ticket, and it's the Willy Wonka, answer to everything. Obviously, recent times, and we'll cover what's happened recent. Obviously, markets have been down, so if people have been invested, it may be less than it had been beforehand, and we understand that you can't have the rainbow without the rain. But if you're looking to invest, if you're sitting there with money on capital, money in deposits, and you're looking to try and invest, when is the best time to invest? Is there a best time to invest, and when is it?
Best time to invest is every day. There's no best time to invest in terms of better than others. It's impossible to predict the markets. As they say, time in the market, not timing the market. It's just important to be invested and be a part of the long-term growth of being invested. And
that's the thing that we band about all the time. Other investment people do it. Time in the market, not time in the market. It's this jumping in and out which is difficult, isn't it? And Steve, why is that so important? Why is the time in the market? Why is it good not to jump in and out? What is the reason behind it?
Because and I will just cover, before I answer that question, I'll just add a caveat to what Josh has said, because I totally agree there is never a bad time to enter the market. But there can be a slightly better time to enter the market, and I just take the one Warren Buffett saying, be greedy when others are fearful, and fearful when others are greedy. That applies to buying houses and investing in markets. But what you do know is with buying houses and buying markets, if you get the right property or you get the right investment and you do it for the long term, you're going to win. You're going to win. So going on to...
And so just key on that, long-term investment's the key, isn't it?
Yeah.
It's about investing for the long term, not trying to, make this
a 5-year investment cycle is typically 3 up years, or 1 level year, 1 down year. It's not every 5 years, but that's normal. Now,
And long-term investment is 5 years plus, just to clarify.
Correct. Now, you're going to have times when you get two falling years. It has happened. In the mid-70s it happened. I think you had a 50% fall, then a 30% fall, and then, my God, it boomed. Mm-hmm. But over that cycle, it still made the profit. Mm-hmm. So that is the key, is that... So Josh says, so if you go about timing the market, if any economist who's writing in the newspaper, who gives often a lot of diabolically bad information to the consumer, if they really said, "Oh, now isn't," and they knew when the right time to invest, they wouldn't be getting paid 50 grand a year writing in a newspaper, would they? Let's be quite realistic. They'd be sitting on a beach in Barbados with properties owned all around the world. So if somebody knew when the best time to invest was, they'd be super rich, not giving you advice on when to do it. So nobody knows, and people that say they know are lying. The bottom line is, you need to, as Josh said, you need to be in the market. If you are in the market over a long period of time and getting the right advice, you are going to make money.
And that's a key distinction to make with what you just said there about economists. You've got some of the best economists in the world, studied it, degrees, everything else like that. They can't predict when it's going to come in. They can't predict the top of a market and the bottom of the market. Yeah. So and they can't jump in and out. So how do you expect the average investor to jump in and out? And it's important. Is the reality is nobody knows, Josh. No. Is that right? Yeah.
No, exactly. And as you'll give the exact figures in shortly, that it's a small amount of days that you need to be invested that gives you the majority of your growth. So if you've only got to miss a few of those, then it's going to really harm your returns.
Yeah, and to come on from that, to lead in, and just some bits we looked at. Steve, I know you was mentioning before, one you wanted to necessarily talk about was the biggest crash since the Depression was the 1987 Black Monday.
People forget that, when they talk about crashes, they forget about the 87 crash.
Because it was nearly 4 years ago, 35 years ago.
But in my lifetime.
Yeah. But I mean, you got the figures. So
so it's the 1987 Black Monday. So the Dow Jones Industrial Average fell 22.8% in one day. Yeah, so it fell to 17.62. So panic set in, and this is some figures that you've done. Obviously, if you'd invested into that £20,000 at the bottom, which I know you don't necessarily buy the bottom.
I was just saying that if you just invested the day after it fell.
After the fell, the 20,000 investment over 5 years would have turned into 36,800. So it grew 84% over the next 5 years.
And how many people do you think the next day after a 22% fall were going to, let's go and invest?
Yeah.
Because I would be going, let's invest.
Yeah, exactly.
But
and you can understand that psychology, right? You can understand that people panic and see that. However, another thing we want to counter. So obviously it dropped 22.8%. But it recovered 57% of those losses 2 trading days later. So it bounced back relatively quickly. But to what you were saying about the trading days as well, if you're out the market for just a couple of days, it can affect in that particular instance, if you'd have come back after those 2 days, it would affect your return by 26%. So instead of it being 36,800 after 5 years, it'd only be 30,000. So effectively those 2 days could have lost you £6,000.
Yeah.
Now that's obviously a case of, but again, that's to prove your point is it can only just take a couple of trading days to miss out on. And if you're out the market, you miss those days.
Exactly.
So obviously, other ones we've talked about as well, and the figures we've got here as well, and again, I was just reassuring that point, Josh, is research from the University of Michigan had showed that 90 days in 30 years account for 95% of all market gains.
Let's say that again, because that is
so 90 days.
For people watching here, when you say let's come out of the market, honestly, of anything you listen to on this podcast today, this bit of information is astounding. So let's say it again.
Yeah. So in 30 years, over 30 years, 90 days accounted for 95% of all gains over those 30 years. If you want to go back even further than that, 96% of market gains in 40 years. This is between 1963 and 2004. So it's a little while ago. But 96% of the gains in those 40 years, from 63 to 04. It was only 90 days is with the gains, and that's only 0.85% of those trades. So it's less than 1% of days over that period.
Incredible. So don't try and time the market. Yeah. Just be in the market, let your wealth grow, let us help you with the investment strategies, and if you do that and you don't panic, you're going to make money.
And let's talk about, I know we talked about it before, and I know we touched on it last time about attitude to risk. So what's the advice to people in this situation? They've seen that the market's dropped slightly, it's understandable people feel the way they feel. What are you saying to people? How do you reassure them?
Well, basically, by previous happenings are the best forecast of future happenings, and don't change your strike cycle. If you've got money to invest, continue to invest. It's the right thing to continue to follow that strategy. Don't think, well, I won't invest this year because market's gone down. Then you could potentially miss a fantastic year.
Sure.
So continue to do what you're doing and understand that it's a cycle. And I have been very delighted about over the last year is the amount of my clients that with getting the newsletters every week and now we started the podcast as well, they are getting a better understanding. So I'm not getting the calls that a lot of other financial advisors are getting because I think our clients are getting a better understanding. Do you not think so, Josh?
Yeah, I can agree.
Yeah, I was going to say that. Is it something, obviously people that don't know this, people watching this may not be clients, but obviously clients, they get a weekly newsletter from us, don't they, just to update of the markets effectively?
Yeah, to be honest, when I speak to clients, new clients, I always reiterate and really hammer home the fact that it's not always up. I had a client call me in February saying, fund's been really well the last year. They had a little dip by that. I was like, it's not always like this. It will go down. So don't be too happy because when it goes down, don't be too sad. And he's like, I'll get it. And then when I spoke to him about 3 weeks ago, it was down, and he said, "You're right. You told me exactly what this could happen, but I understand it doesn't affect me too much."
That's a really good distinction to make because we talk about it being down, but also is the key to not be delighted when it's up as well. So because you have to ride out those,
It's not a straight line up. It goes up. It goes up. It goes down. Sometimes it can go down really far.
Yeah.
Then it'll come back up eventually.
And you can see that on a FTSE 100 chart. If you look at that, you'll literally see the lines.
Well, what I would say to clients, when you're looking at, say, a FTSE 100 chart, and it doesn't look like it's moving, that does not include the dividends that people are getting from it. So that's not how you're investing.
Can you explain that a little bit more for people that don't have to understand about how dividends work?
So for example, if you take the FTSE 100 and it says, well, over 5 years the FTSE has stayed the same, let's say, you think, I wouldn't have made money in the FTSE. But each company in the FTSE 100 will pay a dividend, and it might be 2%, 3%, 4%, 5%. But those dividends are not added into the price, so they are paid out when they are calculating the FTSE level. So it may be that it may look like it's level, but it might have made 4% a year.
Sure.
Similarly, if it's up 5%, that means it might have made 8 or 9%. Sure. So that's just if you invested 100% in the FTSE. But that's what happens with. Whereas when you invest in funds, you invest in the funds and the companies, and the dividends are added back in, so they're automatically fueling your asset price rising, hopefully.
So reinvesting in dividends effectively.
Yeah.
Again, important distinction to make, you said there, obviously this isn't advice. Obviously you need to make sure you speak to a financial advisor, get strategy, and invest in only if you've got money to invest, but it's important. That's why you have to go and get financial advice. Not the same strategy works for everybody, not the same attitude to risk, everything else. I think that wraps up, gentlemen. I think we've covered most things. Thanks for tuning in. We'll bring you next week with what's happening, and we'll catch you next week.